Welcome to the Ontario Mortgage and Real Estate Insights Podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamilton, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're discussing some significant policy recommendations from the Ontario Real Estate Association, OREA, aimed at raising the standards for real estate in Ontario. These recommendations are part of OREA's efforts to enhance consumer protection and modernize the rules governing real estate transactions in the province. Rick Kedzior, the 2024 president of OREA, has outlined these proposals in a recent white paper titled Continuing to Raise the Bar for Real Estate in Ontario. The white paper suggests several realtor-led policy initiatives for the Government of Ontario to consider as they move into the third and final phase of the Trust in Real Estate Services Act, TRESA. One of the key recommendations is to introduce a 2-year articling and mentorship requirement for new real estate agents, similar to trade apprenticeships. This initiative is designed to ensure that new agents are well prepared and knowledgeable from the moment they start their careers. OREA believes that such a program will help agents hit the ground running and serve their clients more effectively. Additionally, OREA is advocating for the introduction of specialty certification designations. This would allow real estate agents to market themselves as specialists in specific areas such as waterfront, agricultural, or recreational properties. By doing so, realtors could position themselves as trusted experts, thereby enhancing their business and instilling greater confidence in their clients. OREA also emphasizes the importance of expanding the Real Estate Council of Ontario's RECO discipline process to include administrative monetary penalties for straightforward infractions, like advertising violations. This change would allow RECO to manage minor infractions more efficiently, freeing up resources to address more serious offenses. Such a move would promote a more efficient and fair discipline process, reinforcing consumer trust in the real estate profession. Rick Kedzior stresses that the Government of Ontario has the opportunity to take bold action by implementing these 9 policy proposals, which could position Ontario realtors as leaders in education and professional standards across North America. OREA encourages everyone to support these initiatives by reaching out to their Member of Provincial Parliament, MPP, and advocating for these changes. Mark Morris, a seasoned real estate lawyer in Ontario, has expressed a critical opinion about the role of Canada Mortgage and Housing Corporation, CMHC, insurance in the current housing market. Originally, the CMHC mortgage loan insurance program was introduced as a government-backed initiative to assist Canadians in purchasing homes with less than a 20% down payment. This was particularly beneficial for those who did not have substantial savings but wanted to enter the housing market. However, Morris argues that CMHC insurance has inadvertently become a major driver of real estate demand, which is contributing to inflated housing prices. Recently, CMHC announced an increase in its coverage limit from $1 million to $1.5 million, a move purportedly aimed at enhancing affordability. However, Morris suggests that this decision may actually exacerbate the problem by further inflating housing demand. He contends that the true issue lies in the disconnect between income levels and current house prices, a situation he attributes in part to CMHC's influence on the market over the past 4 decades. Morris highlights that the Canadian housing market's dynamics can be explained through basic economic principles of supply and demand. While increasing demand typically drives prices up, the demand in this context is fueled by the availability of money rather than an increase in the number of people seeking homes. The pandemic period saw a significant increase in the monetary supply, which Morris argues contributed to the surge in housing prices as more people had the financial means to purchase homes, even if the population size did not change significantly. Furthermore, Morris points out that despite quantitative tightening in the years following the pandemic, CMHC insurance continues to act as a form of monetary stimulus, artificially inflating demand. This has resulted in a market where incomes have become seriously misaligned with house prices, making homeownership increasingly unattainable for young Canadians. He emphasizes that many of those who can afford CMHC-insured mortgages face significant debt burdens, which undermine their quality of life and financial stability. Morris argues that the situation has reached a critical juncture where the average Canadian cannot afford a home even with the assistance of CMHC insurance. For example, in Toronto, the average home price exceeds $1.1 million, necessitating a gross income of $263,300 to afford such a property. In this scenario, CMHC's role has shifted from facilitating home ownership to exacerbating the financial strain on Canadians. In conclusion, Morris advocates for a gradual phasing out of CMHC insurance as a means to reduce monetary demand for housing. He believes that this approach would eventually restore a balance between incomes and housing prices, making homeownership more attainable for future generations. While CMHC was originally established with good intentions, Morris argues that it now poses a threat to the housing market and the economic well-being of Canadians. He calls for the next federal government to prioritize this reform to rebuild a housing market that better serves the needs of Canadians. Let's take a look at the Bank of Canada's recent findings on the impact of mortgage stress tests on the financial stability of the Canadian housing market. As you may recall, these stress tests were first introduced in 2016 for high-ratio mortgages, which are typically for borrowers with smaller down payments. The policy required these borrowers to demonstrate their ability to handle higher interest rates, which, according to the Bank of Canada, improved the credit quality of new borrowers. This improvement was seen through higher credit scores and lower debt service ratios. However, it did not slow down the overall growth of credit or housing prices at that time. Instead, it led to a shift in borrowing patterns towards low-ratio mortgages, which were not initially covered by the stress tests. In 2018, the Bank of Canada expanded these stress tests to include low-ratio mortgages, effectively closing the loopholes left by the earlier regulation. This broader approach was more successful in curbing credit growth and slowing the rise in house prices. It also meant that borrowers within the regulated market had to meet more stringent qualification criteria, thereby improving the overall quality of borrowers. The research further explored how borrowers fared during the recent period of monetary policy tightening, which saw interest rates increase sharply from 0.25% to 5.0% between March 2022 and July 2023. The findings were quite revealing. Regions that were more exposed to the 2016 stress tests experienced smaller increases in credit delinquencies compared to areas that were less exposed. This mitigating effect was particularly noticeable in non-mortgage credit products, like auto loans and credit cards. It suggests that the stress tests enhanced borrowers' financial capacity to manage rising costs. Overall, the Bank of Canada's research underscores the critical role that mortgage stress tests play in fostering financial stability. By improving the quality of borrowers and moderating the dynamics of the credit and housing markets, these measures help ensure that households can manage their financial obligations even in challenging economic environments. This is an important insight for policymakers and industry stakeholders as they continue to navigate the complexities of the Canadian housing market. Let's explore the concept of 5-year hybrid mortgages and their relevance in today's economic climate. In the current environment of economic unpredictability, characterized by fluctuating interest rates and inflationary pressures, such mortgage products are gaining attention. A 5-year hybrid mortgage combines the stability of a fixed-rate mortgage with the flexibility of a variable-rate mortgage, making it an attractive option for borrowers who want to hedge against economic volatility. As core inflation rises, not only in Canada but also in the United States, many are considering hybrid mortgages as a strategic financial tool. This inflationary trend is partly due to statistical phenomena known as base effects, but it also signals a potential bottoming out of inflation, or at least a significant slowdown in its decline. In such times, having a mortgage that offers both stability and adaptability can be particularly advantageous. The economic outlook is further complicated by geopolitical factors, such as the tariff threats from the United States. Should these tariffs come to fruition, they could have severe repercussions for the Canadian economy, potentially leading to a downturn. However, barring these potential disruptions, Canada's consumer spending and employment figures have been more robust than economists anticipated earlier this year. This economic roller coaster underscores the importance of a hedged approach to mortgage planning, which is where hybrid mortgages come into play. Typically, hybrid mortgages are less common among lenders, but there are some competitive offerings available. Some lenders provide combined advertised rates starting around 4.75%. Major banks, such as the Bank of Nova Scotia, offer some of the more attractive hybrid rates. To secure the best deal, it's advisable to negotiate the lowest possible rates for both the fixed and variable portions separately, either through a mortgage broker with strong bank connections or by seeking out a proactive banker. In the broader context of mortgage rate trends, recent weeks have seen various shifts in nationally advertised offers. For instance, there have been minor adjustments across different mortgage categories, including a decrease of 5 basis points for 1-year fixed uninsured mortgages and an increase of 5 basis points for 4-year fixed uninsured mortgages. Notably, 5-year hybrid uninsured mortgages have seen a rise of 14 basis points, reflecting their growing appeal in uncertain times. Robert McClister, a well-regarded mortgage strategist and editor of MortgageLogic.news, highlights the importance of understanding these rate dynamics. As mortgage rates continue to fluctuate, being informed about the options available, like hybrid mortgages, can help borrowers make decisions that align with their financial goals and risk tolerance. In recent news, the Financial Services Regulatory Authority, FSRA, of Ontario has imposed significant administrative penalties on mortgage agent Jaswinder Danoa, amounting to $52,000. The FSRA's decision comes after a thorough investigation revealed that Danoa submitted falsified documents to a lender, accepted payments outside her brokerage, and failed to maintain the necessary mortgage transaction records for her brokerage. These actions were found to contravene the Mortgage Brokerages, Lenders, and Administrators Act of 2006 and its related regulations. Initially, FSRA had proposed a much higher penalty of $140,000. This included 22 penalties of $5,000 each for providing false information, 3 penalties totaling $20,000 for accepting payments outside her brokerage, and $10,000 for causing record-keeping failures at her brokerage. The lender involved, First National Financial, brought the issue to FSRA's attention on December 5, 2021, when they discovered that Danoa had submitted fraudulent proof of down payment documentation and income verification documentation in 22 mortgage applications between April 2018 and June 2021. The investigation revealed that a total of 32 altered bank account statements were submitted in support of these applications, with discrepancies inflating the applicants' down payment funds by amounts ranging from $15,000 to more than $170,000. FSRA also found that Danoa provided fraudulent employment information for 9 mortgage applications, which included fabricated letters of employment and payroll deposits. Through these transactions, Danoa earned $37,942.12 in commissions. However, her brokerage, Mortgage Alliance, withheld the remaining balance due to her failure to provide the required documentation. Danoa initially contested the allegations and sought a hearing with the Financial Services Tribunal. Nevertheless, she later agreed to a settlement with FSRA, admitting to the violations and accepting a reduced penalty of $52,000. As part of the settlement, Danoa acknowledged receiving $51,942.12 in compensation related to the misconduct. This case underscores the importance of maintaining integrity and compliance within the mortgage industry. Regulatory bodies like FSRA play a crucial role in ensuring that professionals adhere to the standards set forth by the industry to protect both consumers and the market's overall health. As always, it's vital for agents and brokers to conduct their practices transparently and ethically to foster trust and reliability in the real estate sector. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.